Hey, everybody. Welcome to this week's Nasdaq Dorsey podcast. It's October 13th. It's coming out the 14th. I have David Clark with me. My name is Will Gibson. And David and I are trying to plan what to say. And really, it's going to be a layup because there's so much to talk about.
There really is. I mean, whether you're looking at index charts, indicators, or group scores, or Dolly right now, I mean, there's a variety of things to talk about. And mainly what we were sort of sitting there pondering back and forth is looking at a lot of these charts, and you would look at one and say, well, that one doesn't look too bad. But then the next one you pull up, you're going, okay, never mind. That wasn't what I was expecting. But
I mean, I was doing that today on the latter side. On one that doesn't look half bad is the Russell 2000. I mean, RUT, IWM, and ETF there. I was looking at that one. Doesn't look half bad. I mean, you're matching like a spread quadruple bottom at 164. Some like major support. You're already below your pre-COVID highs, which is notable. But then you look at some of the other major index charts, and it's like, well, I don't know about that.
Well, and the Russell is one of the ones that you still see holding above that support level. But the other one that's interesting to me, and touched on it a little bit earlier this week in our report, is the fact that we're seeing the Dow continue to push higher right now in its current column of X's. It reversed up this week, being the only index chart to reverse up into a column of X's this week. And then from there, it's adding further, moving above that 29,850 level. And it's still technically, other than the Russell 2000, is the only other index that maintains a buy signal right now, because we've seen the S&P move back to a sell signal. We've seen the Nasdaq do the same. You know, for the S&P, we saw it break that 3580 double bottom on the 20-point per box chart. But other than that, you know, you've seen all these indexes, with the exception of the Dow and the Russell, follow suit. You're seeing some of that divergence. I mean, and we have sort of hinted that in some of our reports, but is by no means to the extent of saying, you know, small caps are coming back. They've made their comeback or anything like that. This is more us just looking at these charts with a lot moving to new lower levels, that this one's holding support. And that's really the extent of the observation.
I heard the saying sometime this week. It's like, we're picking the cleanest shirt in the dirty laundry pile right now.
Or the reference I've made in the past is you're picking the least moldy apple in the batch.
That also holds. Yeah. And if you're looking at some of these charts, and we'll put these on YouTube if you're following along there, the images that we're showing may be a bit interesting. And that's one of the unique rules about point figures. So we're talking about some support levels being violated, but we're also well aware the market's up 2% now at the time of this. We're recording down to, up to in a day. I don't have the stat on the last time you saw that.
Of course, it may be down to right now.
Yeah, who knows? Probably down to.
It's been a fun Thursday.
So point being is that you're looking at some of these charts, keeping in mind that with point and figure, you can only move in one direction per day. So we started the day in O's, and if we fall lower, we're adding O's to the chart, regardless if the market finishes up 2% for the day. Tomorrow, we'll start plotting the highs and lows again. And if those fall at a necessary threshold to reverse, then you actually reverse. So keep in mind when you're looking at these charts today, being Thursday,
you're probably going to see most of these charts in a column of O's, but you'll look at their close and it looks like it maybe could have reversed higher. The thing will be is by coming in tomorrow morning, just looking where they open from there. And if they have a potential to reverse up on that open, then you'll see the charts follow through. So we've definitely gotten a couple of questions about that today, but looking at a lot of these charts, it's kind of hard to find many that look that great. They're few and far between, but a lot of what we've looked at here recently, especially from the index perspective, indicators, and variety of other places, it's just the historic meaning of what's been happening. I mean, 2022 is now following in the likes of years of a 2008. You know, we're happy
in terms of calendar year returns.
In terms of calendar year returns, how tough it was. Those conversations are occurring, and honestly, they've been occurring for some time now, but we're still seeing a lot of these things that from a historical perspective are just crazy to see. I mean, because we've not seen them in 15 years, or we've never seen them happen. And a couple of the things that I thought was interesting this week, looking on a lot of that group score page movement, looking at the asset class group scores, is you see now, first and foremost, the S&P 500 index core fund scores at 2.76, which is the lowest score we've seen for that fund since February of 16.
Yes, bad.
And really, looking at another U.S. proxy, all U.S. equity diversified is basically at its score low at 2.49. Its all-time low is 2.25, seen in December of 2008. Same with all equity funds, 2.18 right now. It's the lowest score since we've seen since 2008 for the all equity funds group. And its lowest score all time was 2.07. So we're seeing some of those groups, especially from the all US equity diversified, all equities, get near those score lows. Now, for the core market itself, sitting at 2.76, it's still a fairly elevated score. Historically speaking, you've got quite some score to give up. It can definitely go lower. The core market can definitely go lower. To give you an idea, we said that 2.76 was the score right now. The all-time low score was 1.39 in October of 2008. So there's the potential for these groups to continue to move lower. And that's something that you can't ignore. And, looking at the fact that we are sitting at these historic lows from scores does not mean the market is bottomed or that it is bottoming. It's just an indication that we've now reached these historic low levels. I mean, we'll watch from here. Forward returns and something like this always look great 6 to 12 months out. But not really many people talk about the 1 to 2 week and the 1 month, what that experience is like. And I think we got a bit of that this year because we saw the rally through the summer, through the early part of August. And now we're,
in March, you had June, then you had maybe this is the start of something else. Who knows? But and I was talking, and we've tried to be more active on Twitter, you yourself and Joseph and others on the team, Ian, sending tweets through. It's almost common for something to come through like, oh, this happened. This only happened 7 times in history. And it's like, maybe we can find something better, which is ridiculous after a year of just quietly chugging to new all-time highs. But sorry, back to the group scores page. That was a quick tangent that I want to highlight. So you mentioned the equity core weakening, that S&P 500 basket of funds. Keeping in mind, though, on a relative basis, out of all groups we're tracking,
it's still high,
78th percentile.
Yeah,
I mean, market's down 20%.
It goes back to the adage of picking the least rotten fruit of the batch right now, or the least dirty shirt in the laundry type of situation.
And people ask, how much more does the market have to take for this equity core reading to fall and you to raise more material cash? And one of the really unique things about this year, and John Lewis was talking about this on our call this morning, that this is a rare year where fixed income is not helping you. If anything, it's actually hurting you more than a lot of areas of the equity market. You've had bigger drawdowns in fixed income indices than you have in a lot of the sectors or broad sectors this year at least. So that's fueling some of this dichotomy where you're seeing a really high equity core, but you're taking a lot of downside.
Well, and a lot of those groups, as far as those fixed income groups, have ranked low all year long. And, when looking at a lot of those scores and talking about relative conversation, you're looking at something that's underperformed all year long, continues to underperform. From a relative standpoint, you either have to have equities fall at a faster magnitude than fixed income in order to get these relationships to change. So, it's not to say that that's a relevant possibility, but it's the understanding that we really would, in order to see this core percentile group fall further, we would almost need a trade sideways out of fixed income or a significant rally and pretty significant downside out of US equities. So, that's something to keep in mind when looking at a lot of these relative relationships. And sort of another thing to keep in mind is with that elevated core percentile rank right now, you do see an elevated money market percentile rank, but some of those strategies like the PR 40-50 strategies right now are still fully invested because we haven't seen that core fall below the 40th percentile to raise the cash yet.
Unless cash is in the inventory.
Which and that's you'll have to take a look at your specific model and figure out which one is which and give us a call. But
that's a bunch of jargon. We don't want to go.
That's getting way into the weeds.
Way too into the weeds. So if you just skip 30 seconds, that's fine with us. Jumping gears here is something that I wanted to bring up before when you talked about like the March run, the June run. You saw a lot of these breadth thrusts happen during both of those market environments where you look at 12 months from now, you're positive 85% of the time or whatever the anecdote was. And you mentioned some of the shorter term stuff, within 6 months can be pretty choppy. And you've seen a lot of that play out this time, certainly being another one of those. Most recently, we had a lot of these kind of double dips from the indicators, a lot of the positive trend indicators, the high-low indicators. I know we highlighted like the all high-low. So all stocks, all domestic and international, those hitting new 52-week highs. I say 52-week highs relative to those hitting new lows. So if you're hitting more relative 52-week highs, that's going up. If you're hitting more new 52-week lows, you're going down. Point being is that that's reversed up a third time under 10%, which I'm pretty sure the only other time you had a third consecutive column reversal up below 10 was like March of 09. And you saw some other things with like the NYSE high low, the OTC high low. And then
kind of following somewhat in similar patterns.
Following similar
third
patterns.
Reversal up below 10%. And it's that 08 or 09 period is the only one you can look back to.
And I think a lot of maybe technicians got used to 2018, 2020, March 2020, June 2020, September 2020, V-shaped.
Or with the exception of early 16 and really 2011, you didn't have anything last longer than a month or two, you know, as far as downward action in the market. So, but at least not for the past 15 years.
Yeah. But if you look before that, it's pretty common to see in these deeper market drawdowns, a lot of these multiple indicator washout levels before you meaningfully move higher. So a silver lining is that we've already had a couple of those. We've had 2 or 3 of those so far this year. So maybe we're working towards something more meaningful here. Glass half empty would still say that it's not uncommon to keep seeing these kind of retests of washout levels because you've seen oversold just become more oversold for most of this year.
Yeah. Well, and of course, all of this is happening right as we enter earnings season. So it couldn't be happening
always happen
at a better time. And I mean, we've had a few reports,
but it seems to always happen.
You know, one might at least conjure that. We can at least think of one particular person that would conjure that thought. But anyways, looking at a lot of the, you know, out on that earnings front, we've got a big couple of weeks coming up. It's over 50% of the S&P 500 is going to be reporting over the next 2 weeks.
Goody.
Even looking at, you know, stocks that are reporting tomorrow, we have a couple notable names. Looking forward to tomorrow.
And this being Friday.
Right. This being Friday, this will be the 14th. So you can look today to see how they're doing. You have Citigroup, JP Morgan, Morgan Stanley, PNC, United Health, pretty much all the way down to Wells Fargo. So quite a few banks upcoming. You have Bank of America next Monday, along with Bank of New York. I mean, you can use the query tool and find all of these for sure, or go to the database reports and use stocks with earnings releases coming up, and you can look at them as well. But it's a big week for over the next 2 weeks, and really 3 weeks because it kind of continues on through the end of the month that we'll see a lot of these earnings. The interesting piece is, as we talked about, it's coming at the best time possible because we're retesting, obviously, or plowed through some of the recent support. And, you know, at least with what we've seen from some of these stocks report, it's been kind of a mixed bag. You know, some have been decent, some have been
I'll be curious to see how the market responds because at least on the economic front, it's been bad news is good news and good news is bad news. You get a solid economic print. The Fed has to hike more, bad news for the stock market in very simplistic terms. I don't know if earnings is the same. Bad earnings, market likes that. I don't know, but that's just conjecture and speculation.
It wouldn't be a surprise for 2022.
Yeah. Stick to the charts. Stick to the charts. More often than not, a single earnings release or a single data point is not going to change some trend or technical picture. Like UNH of the names you mentioned, they're reporting on Friday. Today, if you're listening to this on Friday, 5 attribute stock broke some support, but relatively speaking, looks half decent right now.
Yeah, I mean, looking as far as many other stocks within the Dow, you're not going to find a much better chart than looking at UNH right now. And I mean, there's a couple of stocks that we were looking at earlier that are sort of seem to be boosting the Dow today or helping it out. Chevron seems to be the main one that you're seeing rally pretty significantly. It's flipping back into a positive trend. But
our bottom,
as we're coming to these earnings, I mean, looking at these charts, identifying those support levels, and honestly being prepared for what if, you know, you do see your stock just take on whatever the report may be considered. I mean, I think at this point, good, bad, positive, it's kind of an indifference at this point. If your stock's falling, there's a simple move there, you know, and obviously it's going to depend on cost basis, and there are a lot of factors there. But if the price is falling, there's a conversation to be had.
Yeah, and that's one of the good things about technicals is that the chart will tell you when you're wrong. And you can have some risk management in there to say that if this drops below a 3 attribute or if this falls below this line of support, I'm going to take losses, I'm going to take profits, whatever it may be. So,
Well, and UNH is a great example of that because I mean, yeah, it technically took out a near-term support level sitting at 488 today, but I mean, you still got a lot of support in the mid 450s, 448 as even as a 440 and bullish support line of 432. So I mean, that is a position, right? That is a position where you're holding, you're looking at those support levels. If you see them violated, yeah, it might start to change your tune. But generally speaking, this has been a technical picture that looks solid. It's not tested recent lows like many other charts have. There's a few out there like UNH.
Yeah, there are.
They're harder to find right now, but they're out there nonetheless.
Maybe we get a bit of a stock pickers environment where you pick strong names, strong companies, strong stocks at the same time that look pretty good. I know one that I want to highlight too, Delta. I think they reported last night. I think pre-market today, Thursday. Zero attribute stock's up 4% today. It really doesn't change the picture of the chart at all. I mean, still a series of lower highs, negative trend. Not doing a whole lot for it, despite
and
being
not even a
4%.
Yield play at this point. So you can't even argue that it's worth holding.
As soon as we say that, I'm sure it'll go up 20%, but not actually.
It's just the day.
Who knows?
It's the day where.
Point being is that take the data points as they come, as loudly as they come right now, in overall picture of what's going on. Don't look at a single data point and make that a new change in trend or a new turning point. Look at the chart as a whole and the indicators as a whole, not just single reversals.
Mm-hmm. Well, and I mean, you can't. We live in an analyst world where we can build things to trigger whenever we want them to trigger. The thing of being in and we live in the analyst world, so we have the ability to kind of do that. Then there's the real world practice, which everybody listening here has more of the experience in, and the fact that when you're looking at something like a Delta that right now is a low attribute name, it's making new multi-year lows and it's bouncing. I mean, that may be an opportunity to trim on some of that long-term exposure. Blocking a gain, it could maybe help offset losses elsewhere. I mean, there's many more conversations that can be had about looking at a position like this that's broken down. And then from there, what opportunities you can look for, like in a UNH or another stock that could be out there to say, look, we're going to trim this. Mm-hmm. Now we're going to be looking to this position to add to it as it's a positive technical picture, has held up well, has weathered this market well. Mm-hmm. I think that's where a lot of folks listening to this will end up heading. And what we're really trying to drive home as far as the message goes is looking at these charts and understanding what they're saying, but also understanding what they're saying in context of the overall market and where we're sitting at right now.
I think it's helpful to think in terms of opportunity cost. If you're buying something else, that means you can't buy something else. So the opportunity cost is not just your return from this stock, but even the return foregone on the other name. Right. So thinking of that as well, I think is helpful. But that's all I had. Anything else you got on your tabs? I was just clearing out 30 of them here. So
well, I have 3 different windows open with about 10 different tabs. So it just depends on the minute that I'm looking at it. So this is done for this page.
Cool. Well, I don't have anything else. Doesn't sound like you do either. So we'll go ahead and land the plane. Thanks everybody for tuning in. We appreciate it. We also love the conversation with all of you all as well. If you want to reach out by phone, 804-320-8511, email dwa@dorseyred.com.
We'll see you next week. Appreciate you stopping by.